I'm Bill Price with growthlaw.com. This is a video explaining the entities that you may decide to use for an international investment in U.S. real estate. The first lesson is very simple. Do not operate in the United States as a foreign entity. This is possible, but there are complicated branch profits taxes to calculate, and your worldwide income and assets elsewhere could become subject to U.S. audits. Instead, take advantage of what is called a blocking organization, i.e. a U.S. organized business organization, such as a corporation or a limited liability company, which earns its money in the United States from such things as real estate investment and pays out money to international owners who do not therefore have to be doing business in the United States themselves and do not therefore have to subject the money paid from their U.S.-owned entity to U.S. taxes unless they are a pass-through entity and such taxes are paid to the owners. Blocking entities can be organized in various different ways. The two major types are either business associations, such as business corporations, or pass-through entities, which are usually limited liability companies, real estate investment trusts, or other types of organizations. The difference between the two is mostly a question of taxation. Business associations get taxed at the entity level. After the last tax act, the rate is 21%. There is then an additional tax if a dividend or other distribution is made to owners. So you have double taxation, which is usually a higher tax rate. However, international dividends are not subject to U.S. tax, but in tax treaty countries get subjected to tax because they are earned from the investment having been made in the home country to home country taxation. So a corporation can be a tax-effective way for international owners to invest in U.S. real estate. Pass-through entities are an alternative. This would be a limited liability company or a real estate investment trust. And for these, when taxes are reported, all of the organization's income and outgo is divided up among the owners according to their percentage right to distributions. And those owners pay tax whether or not they get distributions from the entity. All that is due is individual income tax, therefore no double taxation. Of the pass-through entities, there are two major types used inside the United States, one of which is not normally recommended for international investors. These are respectively the sub-S corporation or an organization such as a limited liability company, which is taxed as a partnership under U.S. tax rules. The sub-S corporation is not allowed to operate unless it has a majority ownership of U.S. citizens or permanent residents. Limited liability companies, though taxed very similarly, do not have any such restrictions. So the LLC or a real estate investment trust or equivalent partnership type organization, such as a limited partnership, usually works better for international investors as they bring in money, whether on a joint venture basis or as primary investors and controllers of a development. Your next issue is where to organize the entity. And this varies by state. Some U.S. states have no sales tax. If you are an international realtor, this becomes very interesting. For a real estate developer, however, that's less relevant. What you want to do is minimize state tax on the net income you earn from your development. For this purpose, states like Delaware or Wyoming or Nevada generally work best. Delaware has a franchise tax, but it also has experienced corporate courts and is generally accepted in the finance world as a location for organization of business enterprises. Nevada and Wyoming are cheaper. They also have no income tax, and are generally used in Western U.S. operations, particularly for California or other high-tax states, where organizing the entity outside of the main tax state may be helpful for state tax reduction. One further note on multi-state operation. Operation of a business entity, such as management of a real property, may require local registration and local tax payments, which payments can be paid as royalties, dividends, or other items to a parent will vary state by state. You need good state and local tax advisors. And that brings me to the team that you look at as you are looking for entity choice information. First should be a lawyer who can talk about the legal rights and obligations of managers and members or shareholders in the various different types of legal organization, from limited liability company through corporations or whatever. Second, you need accountants who can do state and local tax compliance and also make sure that federal tax compliance goes through. Third, you may need a banker to establish the bank account for the new business organization and to manage payments to the international parent. I'm Bill Price of growthlaw.com, and I thank you very much for your time.